How to invest in high-paying dividend stocks. So this is part 3 of our Stock Market Investing 101 series, Dividend Stock Investing, finding high-paying dividend stocks. If you haven't yet watched the first video, Stock Market Investing 101, I'll put a link in the description below. Or the second video, How to Buy and Sell Stocks. Now, in my video, Investing Lessons from Buffett I did a few weeks ago, I talked about our portfolio and how we allocate capital within our portfolio and things that we look for to identify stocks that we want to own. And in the video, I shared our investing approach and different things that we look for and different metrics we look for in each individual stock before we allocate capital to a particular stock. And I shared about the dividend yield and growth and payout ratio. So investing in dividends, I love dividends. I love investing in stocks that pay out good dividends. But a lot of new investors make the mistake of seeing a high dividend yield. They might read the paper or see a bunch of stocks and have dividend yield on them, and they'll just go for whichever stocks have the highest dividend yield. And that can be a mistake because it could be that a stock has fallen for a particular reason and it's using the last dividend payment and working out that dividend yield. It could be, so for example, we own a lot of coal stocks at the moment, and based on some of our buy price, we're getting one of our coal stocks 56% dividend yield, and another coal stock we're getting 120% dividend yield based on our buy price. Right now, if you were to buy those stocks right now, and some of them have gone up 8 times, the dividend yield's still 12-14% if you buy right now, and that might look really good. However, you're buying it at all-time highs. So what we prefer is when we look at dividend yield, we look more at the actual dividend itself, and does the company grow its dividend payouts? So do the dividends grow year in and year out? I would much prefer buying a stock that pays a 3.5 or 4% dividend yield. However, it's growing those dividends at very large rates because they're growing their earnings. So I'm more about the growth of the dividend than the actual dividend yield itself. The other thing that a lot of investors need to pay attention to is the payout ratio. I don't like companies that are paying out 80, 90, 100% of their earnings in dividends, because then they're not retaining any capital, reinvesting into the growth of their business. So I like companies that are able to grow their dividends at the same time, maybe only paying out 50, maybe 60%, 70% kind of top in that, so that they're retaining earnings to reinvest into growing the business, growing revenue, growing earnings, and growing dividends. So with that, what we'll do now is cut to a clip about what is a dividend and investing in dividend stocks.
Welcome to What is a Dividend? For many investors, an important consideration is whether a company pays dividends and the size of those dividends. Dividends are a payment from a company to its shareholders. The term dividend is used because the company's profits are being divided up amongst its shareholders. Dividend amounts are usually expressed in cents per share and are paid out on a per-share basis. So the more shares you own, the more dividends you will receive. In assessing the merits of a company's dividend, investors calculate the dividend yield. This shows how much a company pays out in dividends each year relative to its share price. Dividend yield is calculated as follows: annual dividends per share over price per share. Using the dividend yield, Investors can compare the historical income return being paid by different companies. Dividends aren't guaranteed. You should bear in mind that past performance is no guarantee of future performance. There is no requirement for a company to pay a dividend. A company may pay a dividend one year and not the next, although they try to be consistent where possible. The company may not have made a profit and might not be able to pay a dividend that year. Also, some profitable companies choose to reinvest their earnings back into the business rather than pay dividends to shareholders. Companies that do pay dividends tend to follow a regular policy of paying dividends to shareholders. You can search for the latest dividends on the ASX website. If paid, dividends are usually received by shareholders twice yearly, as an interim dividend and a final dividend, although the dates for these payments will vary between companies. After you become a shareholder, the company's share registry will send you a number of forms to complete, including bank account details. If preferred, there is also an online facility where this can be done. Any dividends will be paid into your nominated account, or a cheque will be sent to you, so it's important to keep your account details up to date. There are two important dates relating to dividends which decide eligibility to receive the current dividend. The record date is 5 p.m. on the date specified by the company. Whoever is on the register as a shareholder of the company at that time is entitled to receive the current dividend. It takes time for records of ownership to be changed after shares have been traded. Therefore, an ex-dividend date is set at 4 business days before the company's record date. This means that to be entitled to the current dividend, you must have purchased the shares before the ex-dividend date. If you buy the shares before the ex-dividend date, you will be buying them come dividend, which means with an entitlement to the current dividend. However, shares bought on or after the ex-dividend date do not receive the current dividend. You should check whether a share is trading come or ex-dividend before you trade. Something else you should consider is imputation credits. This can have a significant impact on your after-tax income. For some companies, dividends will have been paid out of profits on which the company has already paid tax. For franked dividends, the shareholder will not be taxed on the full amount of the dividend income that they received. For some investors, for example those with superannuation funds that pay lower tax, the imputation credit may result in a tax credit, which can be offset against other income.
So there you go. Hopefully you guys are a little bit more educated on dividend stocks, what they are, and how we look at dividend stocks. Now, if you guys are interested in having a look at our own portfolio and how we go about researching and buying dividend stocks and following what we do, then you can subscribe to Finance Uncut Insiders, which I've got some great news. We are going to launch it. We have got the numbers. We're at 200 now. So we are launching Finance Uncut Insiders. And look, there is a cost to it. As I said, it's $1 a day, $365 for an annual subscription for our weekly report, where you'll get all of our portfolio, our research and analysis on that. I'll also be sharing some videos that only Finance Uncut Insiders will receive. No one else that follows this YouTube channel will see those videos. But at the moment, we are giving a 30% discount. So you can still get that 30% discount. So it's going to be $255.50 for anyone that signs up now as we launch this. If you want a sneak peek of what the Finance Uncut Insiders report will look like, I'll share a little clip. I'll share a 9-minute clip in a second where you can have a look at it, make your own mind up whether this is something for you or not. But if you are interested, just send us an email to the email address on the screen below, and we'll send out payment details and send out the first report, which will be a weekly report, as I said, and this is for a 12-month subscription. Otherwise, we'll cut to this clip now where you can get a sneak peek of the Finance Uncut Insiders Report. All right, so you've seen in the past few videos Finance Uncut Insiders Report, but this one's going to be a little bit different. So I've talked about how we use Austrian economics as our foundation and how we use a combination of Buffett and Greenblatt's fundamental value analysis. But what I haven't told you yet is Joel Greenblatt. So you just heard about the trading strategies about leap options. Okay, so Joel Greenblatt, who averaged 50% per annum while he ran the Gotham Capital Fund, wrote a book, You Can Be a Stock Market Genius. Okay, and in that book, I think that's probably his best book he's ever written. If you guys have watched the movie The Big Short, the two young fellas in there, Charlie and Jamie, that worked with my buddy Ben Rickett, who was played by Brad Pitt, or that's not his real name, and Charlie and Jamie, their real names are Charles Ledley and Jamie Mai from Cornwall Capital. They had Cornwall Capital. They actually picked up, if you actually read into young, well, they're not so young now, but Charles and Jamie, they picked up Greenblatt's book, You Can Be a Stock Market Genius. And in there, they discovered this option trading strategy called leap options. And it was the leap options that they generated huge returns, huge leverage returns on, which is what we do. And when we come down to our investment portfolio. So here, where are we? All right, getting there. Here we go. All right. So we have a look at our investment portfolio: value stocks, growth stocks, option selling stocks, and our small cap stocks. So in our option selling stocks, this is where we predominantly buy value stocks, and then we write out of the money covered calls, and we also sell naked puts in here. But down the bottom here, you'll see, in addition, we have physical bullion, real estate, cash, and our options trading account. This is where we buy options and trade spreads. So this is where you just heard the strategy is 9% of your portfolio trading call options. With your savings and as you accumulate or allocate capital, 70% into long-term investments and 30% into the trading account here. And all the premiums and dividends that we get, we put into that trading account and continue to grow that and buy options. So this is where we're buying options. Now, at the moment, there's quite a bit of cash sitting in there because we're waiting for other opportunities. We think we've identified opportunities, but we're just waiting for the right time to pull the trigger on that again. But this is where we get these 700% returns, these 780% returns, when we buying stocks, both put options when markets fall, or cyclical stocks like commodity stocks fall based on the fundamentals, and where we buy leap options where there's certain circumstances, situations where we're just buying time, and we get big multiples on that. So if you're interested, once again, in Finance Uncut Insiders, now send us an email below. So the email address up on the screen now, send us an email. Now, I've received numerous emails from you guys. I haven't responded to anyone yet because, as I've said in previous videos, there is a minimum number that we need to get to make it viable, to make it worth my time, because it means I'll have to step back from other roles in our other businesses to be able to dedicate this to. So if we can't get the minimum numbers, I'm not going to launch this, but I'll let you guys know. So if you are interested, want to see my portfolio, how I invest, both my value stocks and all the research and analysis, but also the stocks that we're selling options on and the actual option trades. The expiries, the strike prices, all of those details. Now, it's not financial advice, and in this, we are not encouraging you guys to buy. It's not an endorsement to buy a particular stock or buy a particular option or to sell a particular stock or sell a particular option. All we're doing is showing you the insiders, looking at my own portfolio. It's definitely not investment advice, and you guys have to seek your own independent financial advice and make your own financial decisions and investment decisions. So it's definitely not a advisory type newsletter. But if you guys are interested, like I said, send an email to me to the email below. I have said in previous videos that it's not free. It is $1 a day, $365 a year for a weekly subscription to our investment portfolio. At the moment, we're giving 30% off for the launch. So it'll be $255.50 US for this. So it'll be less than $1 a day for the first year subscription for this weekly Insiders Report. So if you're interested, send me an email. If we hit that minimum amount, then I'll start replying to everybody with more details, with payment options, and I'll start sending out the Finance Uncut Insiders Report. Anyway, guys, if you like this video, please hit that like button. Really do appreciate it. Love to see your thoughts and opinions in the comments below. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.